Hello friends, in this study session, I am going to start new topic working capital and liquidity management learning module from our corporate issuer topic. Very easy and very interesting. Few numerical topic, few theoretical topic. So let's start. There are three learning outcomes. First, and in this video, I am going to target the first one, that is explain the cash conversion cycle, also called as operating cycle, and comparing various issuers cash conversion cycle, whether longer cycle is better or a shorter one. So let's start with the definition part. What is cash conversion cycle or operating cycle, and why it is important, and how various activities of the business are going to impact our cash conversion cycle or operating cycle. So first of all, the definition part. A company's business operation are composed of several sequential activities. So every company is going to perform various activity in a sequence. What are these activities? Number one, they will start with cash, and this cash will be used for making purchases of raw material. This raw material will be introduced in the production process, the second activity. So first activity is purchases, second is production process. This raw material will be introduced in production process for conversion into finished good. So from cash till the completion of production process, that is the stage of finished good, is the amount we have invested in terms of inventory. Capital we have invested in terms of inventory, from raw material to work in progress to finished good. And then this finished good will be used for making sales to customers. So third activity is sales. And once this sales is concluded, again the fourth activity will start. That is, if the sales is done on the credit basis, we have to collect dues from customers. The fourth activity is collection. And again this amount will be realized. So there are four activities which are running in sequence: purchase to production to sales, and then finally collection. Stages from cash to raw material to finished good to receivables, and again back to cash. So this cycle is called as cash conversion cycle or operating cycle. If we see the first two activities, purchases and production, so this purchases and production, here we are investing in the form of inventory. We are investing our capital in the form of inventory. And then when finished good is used for making sales to customer on credit basis, till the time amount is realized back in cash, now our amount, that capital, is now invested in the form of receivables. If I plot these activities, this period in terms of time series, from cash to finished good stage and finished good stage back to cash, let's say we are holding inventory in various forms, from raw material to WIP, work in progress, to finished good, for let's say 6 months, and then this finished good is used for making sales, and from day of sales we will be collecting cash back from our receivables in 8 months. It means the total time period for which our capital is invested in this complete cycle is equals to 14 months. Now assuming that we are also getting credit from our suppliers. So this complete 6 month time is not where our capital got invested, because for let's say 4 months is the period we are getting credit from our suppliers. So anyway, we need not to pay from the very first day when we have done the purchases. We will be paying after 4 months. So for first 4 months, we are using raw material without investing a single rupee. So in all, for what period our amount was invested in this particular process? So 6 months is, this first period of 6 months is called as days of inventory held. So we are holding inventory for 6 months. Days of inventory, the short term is days of inventory on hand, DOH. So for 6 month time, amount was invested in terms of inventory. And then next 8 month, days of sales outstanding, DSO. So in all total 14 months minus days of days payable outstanding, DPO, or the credit period received from our customer or from our suppliers, DPO, days payable outstanding. So net of that value, because for 4 months nothing got invested, so for our business 6 month DOH plus DSO minus DPO, in all the money is invested in one cycle for 10 months. From first day till 4th month nothing was invested, but we are using raw material. From 4th month end, now our money is now being utilized in the process for additional 2 months, because total period for converting from purchases to finished good stage is 6 months. So for 2 months money is being utilized in the system, and from there 8 months is pending with the receivables. So in all the money is in the process, in the cycle for 10 months, and this period is called as operating cycle or cash conversion cycle. So what is the formula of cash conversion cycle? Cash conversion cycle is the days of inventory on hand, or I'll say inventory holding period, or what period you are holding inventory in various form, raw material, your work in progress and finished good, plus your days sales outstanding, or I'll say credit period allowed to customers, receivables. So that is the time period for which again your money will be invested in the form of receivable, minus the credit period availed from your creditors or your suppliers, that is your days payable outstanding, because for that period you are utilizing material without investing the funds. So this is decreasing your cash conversion cycle. So this is the final equation for your cash conversion cycle or operating cycle. Now why this is very important definition from even accounting point of view? Because this operating cycle period becomes benchmark for classifying short-term and long-term assets. For assets, when the intention, not compulsion, intention or expectation is to liquidate or realize the benefit from any asset is within one operating cycle, these assets are generally treated as short-term assets, current assets. And if the expectation or intention is to realize benefit for more than one operating cycle, then these assets are called as long-term assets, fixed assets. From liability point of view, where the intention is to, or the legal obligation is to pay off any liability within one operating cycle, that liability is treated as short-term liability, otherwise long-term liability. Using these definition, we may say that our inventories, of course, they are part of operating cycle. Receivables, of course, they are also part of our operating cycle. Prepaid expenses and cash itself will be treated as short-term assets. Cash include bank balance and marketable securities, short-term marketable securities. From liability point of view, our creditors for purchases, outstanding or accrued expenses, and our short-term debts, all will be classified as short-term liabilities. Now we will discuss various activities and how they are going to impact this cash conversion cycle. Now, question comes is, this cash conversion cycle should be longer or a shorter? X business is having 10 months as operating cycle and Y is having 13 months. Which one is better? Which one is utilizing? Of course, it depends on business model. One can be manufacturing FMCG product, fast moving consumable goods, where credit period is generally low and the inventory holding period is generally low. Second may be a capital goods business, where inventory is also going to be for a longer period of time and generally credit period is also longer. So it depends on the business cycle, but still only by comparing the different businesses operating cycle or cash conversion cycle, which business will be treated better, in a better position. Of course, the business having lower cash conversion cycle, because lower the operating cycle or cash conversion cycle, less capital will be invested in the business. Longer the operating cycle, more amount will be invested in your short-term assets, and higher the amount invested in short-term asset, lower will be the profitability of the business. Because if you are having, let's take example of two business, both started with a capital of let's say 1 million, and this 1 million will be utilized for either investing in fixed assets, machinery, which will be doing the production of goods, or inventory and receivable, your short-term assets. If there are two business P and Q having 10 million and 10, let's start with 10 million, and one machine is of worth 2 million, one machine is of worth 2 million, and if P is investing in operating cycle or cash conversion cycle 4 millions, so P will be left with 6 million for fixed assets, and this 6 million will be used for 3 machines, 3 plant and machinery. Let's assume Q is having lower operating cycle, shorter operating cycle. So this shorter operating cycle means less amount got utilized for your inventory and receivable. You are giving less credit to your credit period to your receivable. You are holding less inventory. Then your cash conversion cycle will be also of lesser amount. Now they are having 8 million, so they will be able to purchase 4 plant machinery. Which company will be making more production, more sales? Of course, Q. So Q's profitability will be higher, but at the same time, Q is also running a risk of cash insolvency, that they will not be able to meet out their short-term liabilities because they are holding less receivables and less inventory to pay off their dues. In this way, this operating cycle, shorter as well as longer, both have benefits, both have negatives also. Longer operating cycle means you are maintaining more solvency, cash solvency, but profitability will be hit. Shorter cash conversion cycle, operating cycle, your profitability will be higher, but there will be a risk of cash insolvency. But generally it is assumed that shorter cash conversion cycle is better, because your less amount is getting, from profitability point of view, your less amount is getting blocked or invested in your short-term assets. So operating cycle means, first, future cash inflows within operating cycle are recorded as short-term assets. What are these short-term assets? These short-term assets are your receivable, your inventory, and future cash outflow within one operating cycle are recorded as short-term liabilities, generally your accounts payable. The bigger number is generally accounts payable. Your expenses, accrued or outstanding expenses, are generally a very small negligible value, are going to have very negligible value. So when this account receivable is going to be recognized, first of all, what is account receivable? Account receivable is the amount due from your customer to whom we have made sales on a credit basis. Inventory can be in any form, your raw material, work in progress, and your finished good. So when these assets are recognized means when they enter into your books of accounts. Receivable will be recorded in the books when we are going to conclude our sales. Sales is concluded when the risk and reward associated with particular goods are transferred to your customer. So when goods product is sold to customer, and sold is generally from law point of view, when risk and reward associated with the goods are transferred to your customer, we can say that sales is done. Inventory is recognized when you receive the ownership. When you receive the ownership means when the risk and reward related to material goods is transferred to you, then you become the owner of that inventory. Then that inventory should be recognized or should be recorded. Recognized means recorded in your books of accounts. Accounts payable means from supplier from whom we have purchased on a credit basis. So we have an obligation. We have an obligation to pay at some future point of time. When to record or when to recognize this obligation? When we have concluded the purchase transaction. When product services purchased, ownership is received. Once the goods are received and we have taken the risk and reward of that ownership of that particular goods, the obligation is now due to supplier. So at that point of time, you should be recording or recognizing that liability in your books of accounts. Derecognition means when these should be removed from the books of accounts or they will be shifted to some other head. So when customers have paid their dues, that is, we have received the cash, then that particular head of receivables should be derecognized, because a new asset will be in the books in the name of cash, which will be or cash balance will be increased in that case. When product is sold, the ownership is transferred to new person, so that product should be derecognized. So here inventory will be removed from the books of accounts, that value will be removed or deducted from the books, but at the same point of time your customer's head value will increase. When payment is done, your obligation is paid. So obligation is paid, that obligation will be removed or reduced from the books of accounts. Now, whether the longer operating cycle is good or bad, of course, we have already concluded the organization having shorter conversion cycle or operating cycle will be in a better position, because their profitability will be higher. So what does this longer operating cycle signals? Number one, from all three point of view, three parts, we can say characterize the longer operating cycle. Number one, from receivable point of view. If your operating cycle is longer, why it is longer? Because either you are holding more inventory in your hand, or you are giving more credit to your customer, or you are not able to make collection from the customer within the due dates or the credit period allowed. And third thing, that you are not getting sufficient credit from your suppliers, because that is deducted here. So what will be the impact of these three heads, increase and decrease, on the cash conversion cycle? Impact of cash conversion cycle, impact on cash conversion cycle, increase cash conversion cycle or decrease cash conversion cycle. If your DOH is increasing, it means days of inventory on hand is increasing. This means you are holding more inventory. First we were holding 3 months inventory, and now we are holding 4 months inventory. Either we are holding more raw material, or we are taking more time for production of finished good, or we are holding more inventory of finished good in our hand. If we are increasing that period, your cash conversion cycle will also increase from this equation. If we are going to give more credit to our customers, more credit period is allowed. From 3 months, we are increasing to 4 months or 6 months. Of course, our cash conversion time will increase, because that period from cash to cash will be more. So again, your CCC or operating cycle will increase. What will be the scenario of DPO? DPO is having negative. The more credit you get from your supplier, less time will be spent by your capital in this cycle. From 4 months, if we get more credit, we negotiate better. Now we are getting 5 months. So 6, 8 and 5, our cash conversion cycle will reduce to 9 months, because now for 5 months without investing money, we are utilizing raw material, we are doing work in this, we are performing processes in this cycle. So our cash conversion cycle is going down. So with the increase in DPO, your CCE will go down, and reverse will be the scenarios in case of decrease in these numbers. So if your holding period of inventory is decreasing, your cash conversion cycle will go down. If you are giving less credit or you are collecting quickly from your customers, your cash conversion cycle will go down. But if your creditors, suppliers are giving less credit, you are not able to negotiate because of XYZ reason, they are having monopoly, they are having more bargaining power over you, then in that case your CCC will also increase. So longer cycle signals what? Number one, of course, longer cycle signals what? Longer cycle means your capital is invested for a longer period compared to industry. This can be first from inventory point of view. Either you are holding inventory which is having less demand in the market, you are not able to turn around your inventory, you're not able to sell that inventory, or that inventory is obsolete, that is why you are stuck with the inventory. From receivable point of view, why longer period is being allowed to customers? Either you are having less bargaining power, less negotiating power with your customer, or your customers are in a problem situation that they are not able to pay you. Again, that is a worsening situation. From DPO, your cash conversion cycle will be longer if your days payable outstanding is less. Why it is less? It means we are not able to negotiate with our suppliers properly. So this is a failure of our purchase department who is doing the negotiation. So what it is saying, worsening customer demand from inventory point of view means our customers are either not liking our product, or our product, whatever we are holding, is now obsolete. Deteriorating customers' financial health or credit quality, they are not able to pay. It means their financial health is going down. Ultimately, we will be the sufferer. And loss of bargaining power with the supplier means our purchase department is not able to negotiate properly with them. So these are the negative signals from our longer operating cycle. What should be the ideal scenario? Ideal scenario for any business will be to have a very short operating cycle, and best one is to have negative operating cycle. Very rare, because negative operating cycle means you are getting more credit period from our customer than what you are allowing to your customers. You are getting more credit period from your suppliers than what you are allowing to your customers, and the period for which you are holding inventory. Very rare you are holding inventory of 2 months and you are giving 3-month credit to your customer, whereas your supplier is giving you a credit of 6 months. It means effectively nothing is invested in this cycle. Everything, all processes, whatever you are doing based on the capital invested by your supplier, which is very good for you. So shorter the cash conversion cycle, better is the situation. Negative is the best. And negative means can result from receiving cash from customer before suppliers are paid. That's what I'm saying. Supplier credit period allowed to you, credit period availed from supplier is more than what we are allowing to our customer, or we are getting advance and we are paying with after a period, after availing the full credit. Several ways to shorten the cash conversion cycle. So now ultimately goal should be to reduce the cash conversion cycle so that our capital is more free for fixed asset and less impact on the profitability. How to shorten inventory? So we have to again move to all, we have to manage these 3 items, that is inventory, your receivable and your creditors. From inventory point of view, we have to reduce the holding period. as the inventory holding period will go down, your cash conversion cycle will also go down. So now how to reduce the inventory? We have to manage in the form of number one, discontinue low or niche demand product, because for niche where the demand we are catering to a very niche market, demand is generally infrequent, we have to hold inventory for a longer period of time. That's why your inventory holding period is more longer. You should be moving to fast moving items so that you need to hold inventory for a very short period of time. Number two, go for just in time inventory. Try to manage with suppliers based on just in time, so that whenever you need raw material, the raw material is immediately available. In that case you will not be required to hold raw material in your inventory. At least that period will be saved. But this again have certain conditions, that your raw material should be of a very standardized item. Your suppliers should be always ready with the inventory. In that case they will be required to maintain inventory. Next, data analytics to improve customer demand forecast, so that you hold inventory only when you are going to get demand. In a peak period only you should be maintaining inventory, so that you can turn around it very quickly. So in case of recession or off peak season, you should be holding less inventory. That can be done only by analyzing your customers demand data. How to manage receivable to shorten our cash conversion cycle? Number one, give less credit. Of course, prompt payment discount, that is also called as cash discount. We are offering 3-month credit because industry is offering, but give credit period along with a discount offer, that if to motivate customers, your receivables, to pay early by giving them an advantage of cash discount. So that may also motivate your receivables to pay early. Late payment fees should be there if your customer is taking more period for payment than the credit period allowed, so that it work as a penalty for them and make them disciplined to pay within the credit period allowed. Tightening credit standard, we should not be giving credit to everyone. Scrutiny should be done for every customer who is asking credit. And work with third party collection agencies. Generally these are called as factors, and they are specialized agencies to collect from receivables. They have full legal and other infrastructures to receive from the debtors. Payable management, the only way to manage is to negotiate with them in a better manner. Or number two, better negotiating suppliers contract or comparing cash discount offered with the third party borrowers. So here we got the numerical part. What is the numerical part? We have to compare same basis. As we are giving prompt payment discount, sometimes suppliers are also giving us discounts if we make early payment. But if we make early payment, the days payable outstanding will be low. If days payable outstanding will be low, our cash conversion cycle will increase. Our cash conversion cycle will increase. If days payment outstanding is low, goes down, our cash conversion cycle will increase. Whether to avail discount or not, we have to think. It's not that we should not be accepting discount because we want to decrease our cash conversion cycle. We have to compare it with what? Let's take an example. Generally supplier offer credit terms in the form of 2/10 net 45. What this means? This means that 45 days. This means that from 0 to 10th day, if you are paying, let's say the invoice value is 100 rupees. So if you are paying from 0 to 10th day, that is either cash sales or within 10 days, you will be given a cash discount of 2 rupees, and you will be net payment will be 98 only. But from 11th day till 45th day, which is the last day of your credit period, if you are paying, no discounts will be given, and you will end up paying 100 on the invoice value of 100. So here you are getting an extra advantage of 2 rupees. If I plot this on a time series from T0 to T10th and T45, if we pay at T10, we are going to pay 98. If we are going to pay at T45, we are going to pay 100. So there is an extra advantage of 2 rupees for this 35-day period. So effectively, what is this 2% in annual terms if we convert it into the percentage form? This 2% is at present percent of invoice value, 100 rupees. And this is only for 35 days. So effectively, if I annualize it, what this percentage will come out as the effective benefit by availing this discount. So this is my principal. This is my maturity amount on the time series. The 98 is becoming 100 in 35 days. In 35 days, so small t is your 35 days. 98 is becoming 100 rupees in 35 days. So what is the effective rate of interest? Using the same compounding interest equation, 1 plus r to the power t by capital T by 360, because this is 365, because this is a in days period. So this is equals to 100 equals to 98, 1 plus your rate power T 35 over 365. So R is equals to 100 over 98, 1 minus minus 1 whole power not whole power 365 over 35 minus 1 into 100. We can calculate this as bracket 100 divided by 98 yx bracket 365 upon 35 equals to minus 1 multiplied by 100 is equals to 23.4524% per annum. Now what this 23.4524% shows? So this ultimately the formula is same compound interest which we are using, and this is called as effective annual rate 1 plus the discount percentage upon 100 minus discount percentage power. So what I have used here is, there is a difference? No, there is no difference here. It is 1 plus discount percentage 2 divided by 100 minus discount. 100 minus discount is 2 whole power, they are saying whole power 365 upon day payment period less discount period, that is 45 minus 10, 45 minus 10 whole minus 1 multiplied by 100. If we see, this is the same equation which I am using here. It is 100 1 plus 2 by 98 whole power 365 upon 35 minus 1 whole multiplied by 100. Now this is equals to 98 plus 2 upon 98 365 upon 35 minus 1 multiplied by 100, which is equals to 100 upon 98 365 upon 35 minus 1 multiplied by 100. So both the formula are same. We are just using the compound interest formula, and this compound interest formula is now transferred into in effective annual rate. So we are going to directly use this compound interest formula as A upon your final payment without discount upon P your final payment with discount power 365 upon your number of extra days, that is your 35 minus 1 multiplied by 100. What this now 23.4524 signifies. What this means? This means that this 2 rupees of extra discount, 2 rupees of discount, what we are getting by foregoing this 35 days of extra credit is effectively bringing us a benefit of 23.45% on a per annum basis. On a per annum basis. So if your bank OD or your cost of capital, if your cost of capital is greater than this R, if your cost of capital is greater than R, equals to R or less than R, what you should be doing? What should be the decision? If my cost of capital is, let's say, 25%, it means if I have to pay 98 at T10, I have to borrow, I have to get finance at 25%, and what 25% per annum, and what benefit I am going to get by taking this discount? The benefit will be 23.45%. So should I take that borrowing or get the finance at 25% and then take the advantage of this 23? No. Do not take discount. Do not avail discount. If my cost of capital is equals to my this R, the effective annual rate of discount, 2 rupees for 35 days is equals to 23.45%, and this is my financing cost also, I'm indifferent. Nothing, no benefit is there. So I'm indifferent. And if my cost of capital is lower, let's say 15% or 20%, I can borrow at 20% and I can avail this discount. I should be taking the discount, because by taking the discount, I'm getting the effective annual rate benefit of 23%. By getting the funds at 15 or 20%, I should be avail discount. So it's not that always we want to minimize our operating or cash conversion cycle. We will be comparing this effective annual rate of discount with our financing cost of capital, and then we will decide whether we want to avail discount or not avail. And by availing discount, if we are availing discount, we are reducing our days payable outstanding. If we are reducing our days payable outstanding, automatically our cash conversion cycle is going up, but still we are making a benefit by comparing it with the financing cost, in comparison to the financing cost. So with this is the type of numerical question where you will be given this term of credit and maybe asked to calculate the effective annual rate. You can use this formula, or you can use this equation of our compound interest to calculate the effective annual rate. And then they may ask you whether the discount is beneficial or discount is not beneficial. So we have to use these rules. So if our cost of capital is lower, it's easy. The financing cost is lower than the benefit of discount, we should be availing the discount benefits. So with this, let's close this topic. So thank you so much. Thank you, everyone.